The picture of the Canadian dollar has never felt as calm as it does today. And that calm is precisely what makes it unsettling. This is no longer just a story about exchange rates. A quiet but powerful headwind is blowing from Washington to Ottawa. US bond yields remain high as the Federal Reserve holds rates, while the Bank of Canada has cut aggressively to support a slowing economy, pushing policy rates down toward the 2.25 to 2.75% range in 2025. The result is a widening interest rate gap of roughly 150 to 175 basis points, enough to tilt global capital decisively toward US debt-denominated assets. By early 2025, net capital outflows surged, with tens of billions of dollars leaving Canadian markets as both domestic and foreign investors sold Canadian equities and accumulated foreign assets. What looked like a routine portfolio adjustment was, in reality, a sharp reversal of confidence. The Canadian dollar weakened, USD-CAD trended higher, and financial indicators from FX liquidity to bond yields began to reflect a market quietly losing faith. A weaker CAD is not just a chart movement. It is a signal that capital is reconsidering its commitment to Canada. So what is driving this silent retreat? Because history shows that when capital starts leaving calmly, the real shock often comes later and far more violently. Capital never leaves randomly. Before it runs, it leaves clues behind. In Canada's case, the first signs emerged in places few people watch closely: the bond market and system liquidity. As the Bank of Canada moved faster than expected on rate cuts, yields on Canadian government bonds fell sharply relative to US Treasuries, eroding the appeal of CAD-based assets. That yield spread is not a technical detail, it is a referendum on risk. At the same time, real estate, the backbone of Canadian growth for 2 decades, began to stall. Prices did not collapse, but liquidity dried up. Homes stayed longer on the market, transactions slowed, and household debt remained dangerously high relative to GDP. Banks tightened lending standards, not out of panic, but out of anticipation. In global markets, Canada's CDS levels remain far below crisis economies. Yet the upward drift signals a subtle rise in perceived risk. This is the classic pre-crisis phase. No panic, no headlines, just confidence quietly cracking. And once liquidity weakens and expectations shift, capital does what it always does. It prepares an exit. Economic shocks rarely begin with collapse. They begin with a chain of decisions that all seem rational in isolation. Lower interest rates are meant to stimulate growth, but when the gap with those rates grows too wide, the Canadian dollar becomes structurally unattractive. Investors sell CAD, buy USD CAD rises, import costs increase, and inflation re-enters through the back door just as domestic demand weakens. The Bank of Canada finds itself trapped. Continue easing, and the currency weakens further. Pause, or tighten to defend the dollar, and the highly leveraged domestic economy risks a deeper slowdown. This policy dilemma is not theoretical. Argentina faced it in the early 2000s. Turkey lived through it after 2018. In each case, monetary policy lost control not because of bad intentions, but because expectations broke. Capital does not wait for confirmation. It leaves when the probability of risk outweighs expected return. Canada is not on the brink like emerging markets once were, but the mechanics of the shock, driven by rates, Currency and confidence are unfolding quietly and uncomfortably familiar. History offers uncomfortable comparisons. In 1997, IMF-backed Asian economies were praised for stability and growth until fixed exchange rates failed and capital fled within weeks. Currencies collapsed, banking systems froze, and the common thread was excessive private debt combined with fragile confidence. Argentina provides a lesson in credibility erosion. Each episode of CAD weakness today echoes the peso's slow decline. When policymakers relied on cheap money while global investors were already turning away. Greece followed a different path. No national currency to adjust, but soaring CD spreads, exploding bond yields, and ultimately a sovereign debt crisis. Canada is not Venezuela or Turkey. But markets do not rank countries by morality. They rank them by relative attractiveness. In a world where the US offers higher yields and stronger growth, Canada risks being quietly pushed to the margins of global capital flows. The impact on Canada does not arrive as a single shock, but as steady erosion. A weaker dollar raises import prices, food, energy, industrial inputs, transforming inflation rather than eliminating it. Cost pressures return just as growth slows, forcing the Bank of Canada to reconsider its easing path. Businesses face a double squeeze. Financing remains expensive, while consumer purchasing power weakens. Real estate, where household wealth is concentrated, becomes the most sensitive fault line. When prices stop rising, debt no longer feels manageable, and consumption retreats. Liquidity tightens across financial markets. Smaller firms struggle to raise capital. Banks grow cautious, not because crisis has arrived, but because risk is approaching. This is the phase where an economy slows before it stumbles, when indicators still look manageable. Yet the margin for error has disappeared. As capital shifts, government and central bank responses shape the speed of contagion. The Bank of Canada emphasizes stability. Strong banks, adequate reserves, manageable public debt. But markets listen less to assurances than to policy signals. Each hint that growth is prioritized over currency stability adds pressure to the dollar. The federal government faces a familiar dilemma: stimulus or fiscal discipline. Spending can soften short-term pain, but in a high-rate global environment, widening deficits invite market scrutiny. Greece believed it had time. Argentina believed growth would return first. Both misjudged how fast confidence can vanish. Canada still has policy space, but not much. In a globalized financial system, a few inconsistent decisions can trigger doubts that spread faster than any stimulus package. Once confidence weakens, policy can slow capital flight, but it rarely reverses it. A weaker dollar means higher living costs, even if wages stagnate. Mortgage holders face a painful reality. Home values no longer rise, while borrowing costs remain elevated. For households dependent on credit, even small rate or currency shifts carry real consequences. Workers in sectors tied to imports or foreign capital feel uncertainty first, as hiring freezes replace expansion plans. Assets once considered safe begin to feel conditional. The IMF's lesson from past crises is clear. Currency stress does not only damage statistics, it erodes trust in the future. Survival strategies are not about predicting the exact moment of crisis, but adapting to a high-risk environment. From Argentina to Turkey, the biggest losses came not from poverty, but from concentration, too much dependence on one income stream, one asset class, one currency. For Canadians, this means reassessing personal balance sheets, variable rate debt, property-heavy wealth, savings denominated solely in CAD. When system-wide liquidity tightens, access to cash matters as much as returns. Diversification is no longer a luxury. Of the wealthy, it is defensive positioning for the middle class. The most valuable insight is psychological. Capital flight is driven by collective emotion. Individuals have an advantage. They can move slowly and deliberately. Not panic, not denial, but clarity about where one stands in the economic cycle. That awareness often separates damage from resilience. The deeper concern is not how weak the Canadian dollar becomes, but how Canada's economic narrative is changing. A country once defined by stability, resources, and predictable growth is becoming increasingly dependent on external confidence. And confidence, once lost, is slow to return. Macro indicators have not reached crisis levels. CDS spreads remain contained, banks remain solid, reserves intact. But history from Greece to the IMF crises shows that collapse rarely begins with the worst numbers. It begins when not bad enough. Data is interpreted pessimistically. The most dangerous phase is normalization. When a weak dollar becomes routine, when capital outflows are dismissed as temporary, society adjusts quietly to lower expectations. That silent adjustment blurs the line between healthy correction and structural decline. In the end, the Canadian dollar is more than a currency. It is a reflection of global confidence in the economic model Canada has relied on for decades. Capital flight is not a verdict, it is an unanswered question. Can growth be reinvented? When real estate no longer drives prosperity and cheap money is no longer safe. History from Argentina, Greece, and Turkey suggests that crises rarely arrive when conditions look worst, but when societies believe the danger has passed. Canada still has time, but not indefinitely. Every policy choice, every market reaction, and every personal financial decision contributes to the outcome. As USDC/AD fluctuates on trading screens, the real question is not tomorrow's exchange rate. It is this: if global capital has already changed direction, what will Canada change to earn back its trust? Or will we learn to live in a world where that capital no longer stays?